we put together some of our data, and I wanted to just talk though about sort of the general conditions, and not about, again, to predict a specific number. Because look, there will be an increase in distress. It's already happening. Distress is very low in commercial real estate at the moment. So it will increase, but the whole discussion, in my view, is a lot more nuanced than yes, the market is good, or no, the market is terrible and we're all going to die,
Hi, Adam Gower here, founder of Gower Crowd and host of the real estate reality show on YouTube and distributed via podcast. Thanks so much for joining me today. My guest on today's episode is Paul Fiorilla, who has been a regular guest on the Gower Crowd podcast over the last few years, and this is his first appearance on this new series, Series 5, the Real Estate Reality Show. What prompted me to invite Paul to join me today was an article that he wrote in Commercial Edge with the headline, with distress on the rise, how worried should we be? Oh my goodness. Well, that's the perfect title of any article to discuss on this show. And that is exactly what Paul and I do talk about today. You're going to hear us talking about industrial real estate, what's going on there, multifamily and office primarily. And then Paul also answers the question, is there a systemic risk? Again, now you're going to find Paul is a lot more optimistic than I am, but there are also going to be some pockets of opportunity if you keep your nose to the data and to the markets and keep your eyes open. There will definitely be opportunities. I should, of course, also mention that Paul is Research Editorial Director at Yardi Matrix. That is his day job. And on the podcast page for today's episode at gowercrowd.com, I will go ahead and include links to his bio. I'll also include a link to the article on Commercial Edge and a link to Yardi. So do be sure to go to gowercrowd.com to see all those other resources. And of course, while you're there, please subscribe to our newsletter. It's completely free. It goes out every Wednesday, and we are covering the world of commercial real estate, investment and finance, and syndications, aka crowdfunding, with a focus on what's going on in the distress world at the moment. Oh, and if you do have the opportunity, do go ahead. This entire series is being produced as a show on YouTube. So go to youtube.com/Gower Crowd, subscribe to the channel there, and you'll be able to see all prior episodes in this series. All right, without further ado, let's get on with it. Paul Fiorilla, Yardi Matrix, here he is. Fabulous to see you again. Always good to see you. Thanks so much for joining me on the show today. So you wrote this article, with distress on the rise, how worried should we be? I would absolutely love to hear your thoughts on that and to have you guide me through the findings and the discussion in that article. So go for it. And I'll prompt you if I've got any questions, which, as you know, I likely will have.
Yeah, great. I always enjoy talking to you, Adam, and feel free to have a discussion. The paper, as you note, the title is a question, so I didn't set out to, give a percentage increase in what distress is going to be. But at the same time, there's been so much discussion of distress. You see, Elon Musk tweeting that commercial real estate is going to have a big increase in distress. Like, what does he know about it? other than him not paying his rent, I don't know. Maybe that's why. Maybe there's just he has so much space he's not paying rent on. He figures that's everyone's doing
maybe
that.
He wants the buildings to go into distress.
Yeah,
so he can buy them at discounts.
And yesterday, right, last night on Shark Tank's Barbara Corcoran, who was a commercial real estate broker, she was talking about it, and you just see it everywhere. So we put together some of our data, and I wanted to just talk though about sort of the general conditions and not about, again, to predict a specific number. Because look, there will be an increase in distress. It's already happening. Distress is very low in commercial real estate at the moment. So it will increase. But the whole discussion, in my view, is a lot more nuanced than yes, the market is good, or no, the market is terrible and we're all going to die. So, so what are the things that are going to, determine how much distress there's going to be? One thing is the property types. Like all the commercial property types have different drivers, different performance right now. Multifamily, industrial, multifamily has had a recent increase in increase in vacancy rates, but it's still by historical standards pretty good. We just had a lot of rent growth over the last few years. It's slowing down, but all the numbers show that demand is holding up and it's still doing okay. Industrial, again, vacancy rates are extremely low by historical standards. They just went through, the highest rent growth period in the sector's history. Storage rates are, street rates and net income have grown quite a bit. Life sciences is doing good. So most of the sectors of commercial real estate still have pretty good fundamentals, but not office, obviously. And when people talk about distress, a lot of time they're just kind of focusing on the office. So the office market, it's got this crisis, caused by work from home, and that's a problem. Retail is kind of in a middle ground. Retail is kind of where office was, or where office will be going forward. A lot of people expected retail to have a lot of distress, and in fact, retail distress and hotel, are the highest property types with the current highest levels of delinquencies and defaults. But again, they're not anywhere near where they were, during 2020 or the peak of the last crisis. So, the property type is a big thing.
So let's drill down on those, if you don't mind, briefly.
Sure.
I've managed to get myself into an interesting dialogue on LinkedIn. I've been big on LinkedIn recently. I really like talking to
before you ask that question, let me just finish with a quick overview of what I was talking about, and then we can get into the details. Because so the factors that are going to determine the distress, property type, market, some markets are doing a lot better than others. Downtown San Francisco obviously is a lot worse than, downtown Miami when it comes to offices. Another thing is the loan seasoning, when the loans were originated. Loans that were originated in the, 2020 to early 2022 period have had a big gap between the interest rates that the current loans are and what the old rates were and what the current rates are. So that gap is another nuance as to how much which properties will have distress. And then another factor, the loan seasoning, the longer that the loan has been, originated, there's been time for net income. And then the strategy of the borrowers and lenders, which is going to range. So all those things are, will be the backdrop of what kind of properties, where, how much, all that kind of all that stuff.
All right, so industrial. So I managed to get into this discussion with somebody on LinkedIn. Who said that, and you mentioned rent growth in industrial, but he said that industrial rents have grown, have doubled in the last 5 years. So, okay, that's an interesting data point. I don't know. I mean, to what extent have rents grown in industrial? But the point that I understand about industrial, one of its primary characteristics is that you have long leases, and those long leases in industrial with these incredibly low cap rates and very, very high values. When you have a long lease, you set the increases presumably at a set percentage rate, or are they tied to CPI, etc.? But for rent growth for an industrial lease to have doubled in the last 5 years means it must have had a 15% bump every year. So what's going to happen to industrial when loans mature and debt service doubles for anything that's been put in place over the last 5 years?
Well, industrial, that's asking rents, right? So each individual property, the rents did not double on, each individual property. So, the new asking rent has gone up quite a bit. But every property hasn't experienced that kind of a rent increase. But, as far as that goes, look, industrial, the things that will determine distress are property performance, and then like you were talking about, the increase in the interest rates and how properties are capitalized. So the fact that, again, industrial vacancy rate, the national vacancy rate, I think Commercial Edge's latest number was something like 3.9% or 4%, right, something like that. That's really low. So those properties, they have tenants, they're paying their rent. For an industrial property to go into default, there would have to be a massive increase in the the debt service, which will happen, and also either a flattening or negative performance, and we're not seeing the negative performance. In a situation where you have a loan maturing and a debt service being some kind of a big jump in debt service, and let's say the value of the property has decreased, although industrial property values have increased a lot in recent years. If you had, say, a short-term loan that comes due, and there's a gap between the old mortgage and what you can get on the new mortgage, I think that's where you're going to have the negotiating strategy come in, because lenders don't want default. We saw this in 2008 to 2010, right? The derisively term, the derisive term, extend and pretend,
right?
And that, so defaults never got as high as people expected back then, and that was when we had a massive recession and years of sort of negative performance. Here today we have good economic performance, good property type performance, when you're talking about industrial. So the likelihood that would produce, in the case where a property owner has some kind of a capital gap that they have to fill, chances are they'll find somebody to either provide some preferred equity, mezzanine loan. The bank will extend. They might have to put in some extra additional equity, or pay down reserves, or contribute additional reserves, or but the chances are slim, I think, that in that kind of a situation where there's a maturity default on a performing property, that you'll see a huge increase in defaults, because the lenders in those cases will be inclined to work with the borrowers. Now, that's not the case in other property types, like office, where we've seen with office, in some cases, well capitalized companies handing back the keys to properties that are not strategic, and that's a decision on the part of the borrower. They could pay, they could some of the big companies that have done this certainly have the financial means to pay down some of the debt and not default, but the properties are not strategic. So they do that. So I think that's where you get into the nuance. It's just you can kind of create a do the math and say, well, how many properties are, have loans maturing? How much of property values changed? What's the difference in mortgage proceeds based on different mortgage rates and debt service levels? But in the end, not every property that has let's say that not every property, in fact, most properties, if you look historically at CMBS, most properties that have debt service coverage of less than one, most of them don't default. You think, well, if you've got, your income is less than your mortgage payments, right? That's what produces default. And sometimes it does, but historically, most of the properties in that situation do not actually default because the borrowers want to continue to hold the property, either because they think, that they're going to turn it around and increase income, or maybe they're getting management fees that don't go into the NOI, so they're making income from the building in another way. But just having higher mortgage payments and negative value will definitely increase the default rate. By how much, it's still up for debate, I think.
To
And
be seen.
right.
Yeah, I mean, the conversations that I have with lenders are that they are concerned, again, just sticking with industrial, and we'll move on to some of the other points that you brought up in the article. But they are concerned about industrial, that lease bumps on long-term leases have simply not kept up with the rapid increase in debt costs, and that if the DSCR does fall to sub one, banks can't keep those on the books. I mean, there's a limit to how far banks can, as you said, extend and pretend or kick the can down the road. If DSCR's debt service coverage ratios, if the income coming off the asset, the net income coming off the asset is less than debt service, that is a problem for a bank. They can't hide that. If it's above, they can cover it. In terms of how they account for it, but not if it goes below DSCR. And that's the concern that I'm hearing from lenders and from banks, but particularly about industrial, because the prices of industrial over the last few years have been so incredibly high, based on sub 3 caps in some cases.
Yeah, no, I agree, and I think that you will have some cases, but again, I also think, my opinion is that, if the property is performing, and most of them are performing, there's still a lot of demand for industrial, that the lenders and the borrowers will find a way to negotiate and extend in some way, and actually throw the properties into default. In that particular property type, I think multifamily is in the same boat.
Right. So just to wrap up that piece or that conversation about industrial, you noted in the article, and I will post this, if it's okay with you, Paul, I'll post a link to the
Sure.
article on the podcast page at gowercrowd.com. So if you want to read the full thing, it'll be right there. But Paul does note that he talks about a wall of maturities, loans on 15.6% of office properties and 13.5% on industrial properties will mature between 23 and 25. So that's basically in the next 6 to 18 months.
Right, and that was a study of commercial edge data. The data in we have national databases of office, industrial, and multifamily, and retail, and self-storage.
Now, you also talked about maturing loans by market, right? So this debt service issue is obviously really what's causing all the chaos at the moment. So what are you seeing regionally, Paul, and where are the hot spots for distress, do you think?
Well, I think in office, for example, look, there's the places like San Francisco, Los Angeles, New York, some of the big office markets where people are still not going into work. You go there and office buildings are pretty empty, and when the leases mature and come due, the property, the tenants will negotiate smaller spaces, our company is starting to do this. Other companies, some companies have started to do it. But it's going to, because office leases are, 5, 10 years or longer. It's a slow process. It's taking years. We're also seeing, that Class A, properties with the best amenities are doing okay. The absorption is strong in buildings that have been built, in the last, decade or so, and older buildings are doing less well. That's where the negative absorption is. But I generally think, the biggest office markets, which have the hardest commutes and, the longest commutes and the biggest potential drop in space are going to have, and also where the property values were the highest. You look at New York City, where, cap rates were really low, office space was very expensive. They're going to suffer the biggest decline in values and, the biggest potential for distress. And that's where, I talk about, pockets of distress, and, core market office is one of those pockets that, distress is going to increase fairly, high in the next 3 to 5 years.
Paul, do you want to take a look at this chart? It's actually a very interesting chart. I'm going to move my camera. I can share the screen with you. It's the one in the article that is office loan maturities by metro and vacancy rates. Do you want to take a look at that? Just kind of walk through the particular
Sure.
area. Is that okay?
I'm not seeing it yet, but
Yeah.
is this
I want
is
to
this
be
my
sure
chart,
you're
or is
okay
this a
with it.
different chart?
This is the one from the article here.
Oh, okay. So this is our chart, right? Okay.
Yeah, so just, I mean, for somebody who's listening and not watching the show today, oops, I managed to lose it.
Yeah, that's okay.
Just go ahead and walk through. What are we looking at here?
All right. So what we did with this chart was we went through our database, and we we calculated the percentage of loans of square feet of space in different property types. In this chart, we're looking at office. So we're looking at the percentage of office space that has maturing loans between now and the end of 2025.
Mhm.
And the bubble size is the amount of square feet that represents. So the bigger bubbles are, metros with a higher amount of square feet of maturing loans, office loans. And then we plotted that on the other axis against the vacancy rate of that market. So if you look at, one metro that stands out as, Atlanta, almost 30% of the loans on office buildings are maturing between now and the end of 2025. And it also has, a fairly high vacancy rate compared to some of the other metros. The markets with the highest vacancy rate are Detroit, Austin, Houston, Denver, Atlanta.
Mhm.
But, if you look at over time, New York and San Francisco, for example, used to have very low vacancy rates. They've shot up a lot faster, since the start of the pandemic. I mean, both of those had, single digit percentage vacancy rates 3 years ago. Now they're, close to 20%, or in the 20, near Manhattan's about 17, San Francisco's close to 20. So, you can see the trend there, that those markets have had the biggest impact from, the work from home post-pandemic. So if you look at the markets where, property performance is weak and has a high percentage of loans maturing, those are the places where the likelihood is you're going to see more distress. On the other end of the spectrum, Charlotte, Miami, Boston have relatively low vacancy rates, and the not a huge percentage of the the office stock has maturing loans. Now, this is meant to kind of give a broad picture. Distress is going to be determined by individual property characteristics and performance.
Right.
But this is just again, an illustration of the some of the nuances I'm talking about. Um, you know, what's the performance in a market, and you know, what is the potential size of the problem in the short term.
All right, let's scan down. There's another chart down here. This is the industrial loan
Yeah.
maturities by metro and vacancy rate. So, you mind talking me through this one? This one's interesting.
Yeah. So industrial, you can see from this that the bubbles move in a different direction. That the vacancy rates are very low. The middle of the chart is right about 4%, like we were talking about before, and there's only a handful of markets that have vacancy rates over 6%. And the long-term historical vacancy rate is probably 6-7% for industrial. So pretty much every market except Houston, Denver and Boston are below the long-term historical vacancy rate. So industrial fundamentals are pretty good. And then when you look at the markets that have a high percentage of maturing loans, Columbus, Atlanta, Phoenix, I mean, those are markets that are strong and growing, and I don't expect to see a big drop off in demand for industrial in those markets. There is another thing to talk about would be the space under construction, which is high. In industrial, it's over 400 million square feet, and for the last few years, and that's all gotten absorbed. I think as we're starting to see a slowdown, potential recession, the absorption of industrial is going to tail off, but it's still relatively strong. Now, office, when we look at construction, there was a couple of years ago, there was 160 million square feet of office space under construction. There's not a lot of new office starts for obvious reasons. That number, according to Commercial Edge in our most recent monthly report, is down to like 118 million. So as buildings are delivering, there's not a lot of new product, and that new development pipeline is going to diminish over the next couple of years. In the same fashion as retail, right? There's not a lot of new retail built unless it's has a specific, is being built for a specific tenant or as part of a new multifamily project or renovation in a downtown, those kind of things. But there's very little spec retail. There will be going forward very little spec office. In industrial, it's been very high, but that will slow down.
Now, of course, you do ask, before we get to your multifamily report, and I'm going to ask you for a sneak preview of what I know you've been writing about over the last 24 hours. But before we get to that, you do ask this lovely question here, and I'm pretty sure I know what the answer is, or how you're going to answer this. But the other question I'll ask in this paper or this article is there systemic risk again? So let me ask you that. Is there systemic risk?
No.
Okay, and on to the next question.
No. Look,
Why? What's
I
different
don't
this time?
think that look, first, what I'm talking about um, in the last 25 minutes or so, I don't see the vacancy rate, I'm sorry, the delinquency rate rising as high as other people might predict. And I talked a little bit about my reasons for that. I think there'll be pockets, but right now the current delinquency rate is very low. Multifamily industrial, it's less than 1%. Office, it's it's fairly low. It's about 4%. A little bit higher in retail and industrial and hotel. But we're starting out at a very low number, and whatever that increase will be, will be, we're not going to get to the double digit, in my opinion, delinquency rates that we saw in 2008, 2009, or in some of the even further back real estate downturns. So when we're talking about, say, for multifamily going from 1% to 2 or 3%, whatever that is, that to me is not a systemic issue. Another reason I say that is because I don't see that lender behavior has been anywhere near as bad as it was in some of the previous cycles. You go back, I got into this market in the mid 90s, and, it was just in the wake of the, an S&L crisis, which was, a huge, you saw properties, portfolios of properties being sold at a fraction of their value. When you look at, 2000, the global financial crisis, 08, 09. In the run up to that, lenders had been doing, 90, 95%, even higher in some cases, loans. There were acquisitions of huge portfolios with dozens of, mezzanine tranches that all blew up. Even as lenders have become more aggressive in the last few years, they haven't gotten anywhere near as aggressive as they were. So the problem is that because interest rates are higher, prices are going down, cap rates are up, prices are going down. And that is a problem, and that will create distress. But one, I don't think that it will create as much distress as we saw in 2008, 2009. But also because, the banks are in much better position to handle losses. Look, commercial real estate is a small part of the, the bank world. And, residential real estate is a much bigger sector. And whatever the losses will be in commercial real estate, it won't be anywhere near big enough to be, a systemic risk to banks. Now, if there is something happening outside of commercial real estate that creates systemic risk, that's an entire possibility too. Although I also, I'm not a bank expert, but I also think that that's unlikely. The Dodd-Frank reforms, banks have been more highly regulated this time around. We don't have all the, in addition to the aggressive lending, we don't have all the, the credit default swaps and all the, reference pool trades that were made in 08, 09, which I think were a big contributor to, the systemic risk. So I think banks are in much better shape, and the overall level of delinquencies is not going to be as high. And then, look, also, I can add this too, the economy, despite the predictions we've had, over, 15, 16 months now of a lot of predictions of gloom and doom about the economy. Rates are going up. The Fed is trying to force a recession. And yet this morning, what do we have? Another 300,000 jobs added. We don't look like we have a wage price spiral. The Fed's probably going to stop raising rates. Rates are, they're obviously not destroying the economy now, right? There's a lag, so maybe in a few months, but there's no real sign that we're going to have, a big economic stress event. So add that to, on top of the other things I said. So, it's fun to, speculate about, the next big crash and all that. But, maybe a year from now, we can talk and you could say, hey, I told you, you were all wrong.
Well,
but
a year from
my
now,
opinion is I don't see that.
Oh my God, in a year from, I don't even want to think about a year from now, because we will be deep into election season. Oh my goodness, that's something to look forward to. Not, I think.
And look, the credit, I'm sorry, the debt limit was a potential exogenous event that could have created a huge problem. And I was actually kind of pessimistic about, them coming to an agreement, but they did, right? And that was, a potential thing. Now there are other potential exogenous events, and we've seen
Black
things that
swan
nobody
stuff, right?
expected.
Yeah,
Like, yeah,
exactly.
but I mean, like in 1998, there was a very short-lived but a very steep downturn because Russia defaulted on its bonds, and it created ripples throughout the financial markets, including the CMBS market and real estate. So imagine if that's Russia, a very small country in the global financial system. If the U.S. defaulted, that would have been catastrophic.
Right.
But looks like we've avoided that. So there are one less thing that could potentially blow up the economy.
Let's wrap up. You know that I'm trying to. I told you I'm trying to keep these to average commute time. I do like to joke. Average commute
Yeah.
to America is 30 minutes, and here in LA it's 3 hours. Anyway, so let me wrap up with two questions. I have one final question for you, but before that, I know that you've been working on the latest multifamily report over the last few hours, last couple of days. Give me a sneak preview. What are you seeing? What's going on in multifamily? What are the highlights coming out of that report?
Yeah, so multifamily demand is holding up. What we're seeing is that rents went up nationally. The average asking rent went up $7. What we're consistently seeing is sort of normal seasonal growth, but less than the typical year. So if you go back the last few years, 2020, the world kind of was, changed by everybody staying home. Rents kind of froze and kind of went down for a couple months. So 2020, the spring of 2020 was an outlier. And then 2021 and 2022, we saw an explosion of rents brought in by, an increase in demand, people working from home, households forming, uh, people wanting to, move away from roommates, moving away from parents. The household formation was extraordinarily strong in those last couple of years, created a demand for housing, and rents went up, nationally 22% over those 2 years. It was, by far so those were outliers as well. So this year, so far this year, rents have gone up $17 since the beginning of the year. It's about 1%. Normally at this, the average rent growth in, long term going 20, 30 years is something like 2.8% or something like that. And, so this year we're probably going to, where it looks like we're going to have growth just a little bit shy of that. And when we look at it regionally, there's a rotation. So the markets that had the biggest increase over the last couple of years are starting to, rents are starting to decelerate and turn negative, which again, it's not unusual. Those markets are still fine, Austin, Phoenix, places like that. It doesn't mean that there isn't any demand or that it's just that there's, you know, rents went up. Now we're kind of coming back to normal. Number two, those markets have a lot of supply growth. So as demand slows, demand isn't negative, but as demand is kind of coming off like really strong levels back to more normal levels, and you have a lot of new supply, that depresses rent growth. So the markets now with the highest year-over-year rent growth are places in the Midwest: Indianapolis, Kansas City, New York, Miami's still doing okay. So the places that didn't have like huge bump up in rents over the last couple of years are staying kind of consistent. New York is kind of interesting because Manhattan, the occupancy rates are at all-time highs, and everybody who thinks that nobody wants to go to be in New York City anymore, well, they do, because the apartment market rent growth is higher, is as high as it's ever been. Rent, or I should say, the average rent is as high as it's ever been. Rent growth is strong. And occupancy rates are extraordinarily high, the highest in the nation. Our data is 98%. So our data set is just properties with 50 units or more, but still, it's doing well. So basically, multifamily, it continues to do well, absent, any kind of, huge bump to the economy. People have jobs, people have income. The lower end of the scale is going to be a problem, because of affordability. But, the vast majority, the big picture apartments is still doing solid. Growth is slowing down, but not a housing recession or a housing bust or anything like that.
Paul, thank you. All right, I'm going to ask you one final question that I'm asking everybody on this new series of the Real Estate Reality Show. And I'm actually really interested because I know you spend a lot of time. I mean, your job is to do research and to comment and to analyze data. So and presumably you use a lot of proprietary databases, including those that sit on your desk there at Yardi. But what resources do you use that mortals like us can use, and that the viewers of this show can use to keep track of what's going on in the commercial real estate industry? What online resources do you like to use? What media? Any podcasts? Like, what do you like to track to keep in touch with what's going on?
I read an enormous amount of stuff. We have, as we've discussed, we have our own data, which is our, my primary method of analysis. So we have, I use that to understand what's going on. But, there's an enormous amount of news sources and, companies, the Moody's and, the JLL, Colliers, CBRE, all the, the brokers put out research. I read a lot of industry research. And so, I get, a lot of more than I can actually physically read in any given day, but I try and read as much as I can. And, and then I am active in industry trade groups, and, have talked to people and, attend events and keep in touch that way too. So, it's a very broad, amount of information, different sources.
Paul Fiorilla, thank you so much. As always, you're a regular on. You've been a regular on my podcast. This is your first appearance on the Real Estate Reality Show. It's a YouTube show that I also distribute by podcast. Always,
I gotta stop paying you.
Always happy to do that. It's just an enormous pleasure to see you, Paul. Thanks for joining me. Thanks for joining me today.
Yeah, great. Always enjoy talking to you, Adam, whether we're in public or not.
All right, that was Paul Fiorilla, Research Editorial Director at Yardi Matrix. It's always a pleasure to see Paul and to have him on the show. He is a wealth of information, as you can tell. He uses some very high-level proprietary data to provide his insights, or to gain his insights. And then we all benefit from him sharing them with us. If you have a chance, please go to youtube.com/GowerCrowd and subscribe to the channel there. You will get access to all of the episodes in this series of the Real Estate Reality Show. And if you want to get on our newsletter, go to gowercrowd.com. You'll see a big red subscribe button on the page there, top right. It's completely free. It comes out every Wednesday. We cover in detail the real estate syndication and crowdfunding industry. And at the moment, we are focusing on distressed real estate, how to find it, how to invest in it, how to benefit from any wealth transfer that may or may not be in our future over the next few months. Paul, thanks so much for joining me. It's always a pleasure to see you. And thank you, dear viewers, for tuning in today. Really appreciate it. But for now, this is Adam Gower signing off.